Hey, good afternoon, everybody. Uneducated Economist here. Sorry I have to do this from here. You're probably going to get some traffic in the background. We just have to deal with it. Got family in town, so I haven't been able to put out a video for the last couple of days because, family comes first, and unfortunately for you guys, YouTube comes second. Although I had to get a video out because we have to talk a little bit about the monetary policy statement that the Federal Reserve just came out with. So pretty much they are going to maintain interest rates right where they are. They're not going to raise them or lower them, and they are going to continue the unwinding of their balance sheet. So if you're not familiar with the unwinding of the balance sheet, basically the Federal Reserve during the financial crisis printed up a bunch of money, bought treasury bonds and mortgage-backed securities. Recently they've been allowing those things to mature and roll off the balance sheet. What that means is that Federal Reserve notes are coming back to the Fed and they're essentially destroying them, right? Federal Reserve notes, those are the paper dollars that we use. Now, they are going to maintain this balance sheet roll-off until September, which means like another $350 billion worth of Federal Reserve notes will be coming out of the market. That's the shrinking of the liquidity, right? That's the dollar getting stronger. Really considering that the rest of the world is trying to go into a easing program where they're weakening their currency, that really gives the dollar like an opportunity for the next few months to go very, very strong. So some of the changes to the statement that the Fed came out with and stated, previously in December, or they said December indicates that labor markets has continued to strengthen and that economic activity has been rising at a solid rate. They are now saying January indicates that labor markets remain strong, but that growth of economic activity has slowed from its solid rate in the fourth quarter. So did you guys catch the difference there? December indicates that labor markets has continued to strengthen. They are now saying labor markets remain strong, right? So they're no longer strengthening, they're just strong. Job gains have been strong on average in this is what they said previously. Job gains have been strong on average in recent months, and unemployment has remained low. They are now saying payroll employment has little changed in February, but job gains have been solid. So did you guys catch the difference there? They said job gains have been strong, and now they're saying job gains have been solid. I'm not sure what the difference is, but they changed the wording of it. They also changed it from job gains have been strong on average in recent months and unemployment remained low. Now they say payroll employment has little changed in February. Now, job gains and payroll employment are two very different things, right? So jobs are basically all the work that people have out there, plus the positions that are open. Payroll employment is everybody who's working, who basically is on the payroll, regardless if you work like a couple of days or on vacation or what, but as long as you're on the payroll. So those are two very different things that they're talking about. You got to listen to the wording to make sure that you're cluing in on the right things. You're not thinking of, when they do that, sometimes you think they're the same thing, but they're not. And the payroll employment was little changed, right? So job gains, it went from job gains being strong to payroll employment is little changed. Okay, so that means it's not increasing very much, or at all. Right. Here we go. Household spending has continued to, this is what they said before. Sorry guys, I want to make sure and tell you that. This is what they previously said. Household spending has continued to grow strongly while growth of business fixed investment has moderated from its rapid pace earlier last year. All right, so even previously they were saying that the business fixed investment has moderated from its rapid growth, okay, from its rapid pace earlier in the year. And business fixed investment, that's the like when businesses build new structures and buy equipment and stuff like that, not inventory, okay? And you know what household spending is. So that's what they said before. Now they're saying recent indicators point to the slower growth of household spending and business fixed investment in the first quarter. So you guys get that? They're saying a slower growth of both household spending and business fixed investment. So that's very much different from household spending has continued to grow strongly. So it went from that last statement to now it is this points to slower growth of household spending. So you can see that things are starting to slow down and not looking too good. Anyway, moving on here. Back then, this is what they said, on a 12-month basis, both overall inflation and inflation for items other than food and energy remain near 2%. Now they say on a 12-month basis, overall inflation has declined, largely as a result of lower energy prices. Inflation for items other than food and energy remains near 2%. So I'm not sure what the difference is, and maybe I got to look it up and research it a little bit more. I'm not sure what the difference between overall inflation because it says overall inflation has declined, but then it goes on to say inflation for items other than food and energy remains near 2%. So I don't know, maybe there is a difference between those two, but it sounds like those are the same things, and I'm not quite sure why they separated them, but they did. Okay, let's see, moving on here. Well, I guess, we should probably step back to what they said before, because they said both overall inflation and inflation for items other than food and energy remain near 2%. They separated that out and moved that to overall inflation has declined, largely as a result of energy prices, but inflation for items other than food and energy remain near 2%. There's something different in there, and I'm not quite exactly sure, other than the overall inflation has declined largely due to the energy prices. Maybe that's because we're starting to export so much money and that, or that too, but export so much oil, and because of that strong oil export, that's adding dollars to it. Maybe that's what it is. Maybe you guys can think about that one a little bit and help me out with that one. Okay, what they said before. Although market-based measures of inflation compensation have moved lower in recent months, survey-based measures of long-term inflation expectations are little changed. Okay, so inflation compensation. This is are you guys familiar with TIPS, the Treasury Inflation Protected Securities? This is the compensation for that, right? I'm pretty sure that's what they're referring to. And so basically, if inflation is going to be very high, then those TIPS would pay out a lot more. If inflation's low, then the compensation from TIPS, it diminishes, okay? So market-based measures of inflation compensation have moved lower in recent months. Survey-based measures of long-term inflation expectations are little changed. So the long view is that, inflation expectations out in the distance are not very worrisome, but the recent inflation compensation has moved lower. So the expectation of near-term inflation is not very high, especially considering that the compensation from it is lower. Now they are saying, on balance, and this is what they put in there, on balance, market-based measures of inflation compensation have remained low in recent months, and survey-based measures of long-term inflation expectations are little changed. So they added the word "and." They said remain low in recent months and survey-based measures of long-term. And I'm not sure why they added that "and." Oh, it's "and." Oh, that's what it is. Okay, so they're actually including the fact that both the compensation is low and the long-based measurements is low. That's why they added the word "and," because compensation has remained low and the survey-based measures has also remained low. That's why they added the word "and." You got to look for every single word. Because see, I'll put the link down in the description for you, but all the words that are crossed out are the words that they have removed from the statement, and all the underlined words are all the words they added to it. So you got to look and see why and the reasonings behind it. But that must be what it is because their expectation of inflation both in the near term right now and in the long term are very low. Anyway, I hope that helps out with the statement. You guys can go and read the rest of it. Maybe let me know some other things that you might find in there that you think are interesting. Uneducated Economist, let me know what you think of the new haircut. Looks pretty good, right? Okay, talk to you guys later.